Dear viewers, when we check through the corporate results and the growth numbers announced by the country's central banks and the corporates, the growth is here. The growth is going on as per expectation. If this is the case, stock market should have continued their bull market journey. But what's happening in the stock market? The stock market is falling down day after day. There is something which is missing here. Probably there is a season which is changing in the stock market. To say the season may be a very mild word. Probably there is a climate change which is happening in the stock market. In this episode on NRI Money Clinic, I am going to talk to you about what exactly is happening in the stock market, what might happen going forward, and how as an investor you have to position yourself. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, practicing financial planner.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, 2 years prior, the world saw the onset of pandemic of coronavirus. As a reaction to this pandemic, the stock markets fell across the globe for a period of 2 to 3 years. Then the central banks intervened, and suddenly a massive rally in the stock markets unfolded, and it took markets to unknown heights which was never seen before. The world was going through a turbulent times. Growth was not there. Private sector was not doing anything, but the stock market was dancing on the top. Now the world is slowly limping back to normalcy from the pandemic, or at least it appears like that, unless one more wave devastates the economy. The world is coming out of the pandemic. Growth numbers are here. It is there for everyone to see. But the stock market is coming down. It's a funny world. The stock market's dancing to the top when the economy is not doing well, and the stock market coming down when the economy is doing well. There is something which is missing here. What's really happening in the stock market? To know this, we have to dig a little bit deeper into the news that is coming in, and we have to dig a deeper into some part of the history of stock markets as well. First, let us look at the news items. Last week, Indian RBI governor increased the repo rate by 40 basis points. He also increased CRR, otherwise known as cash reserve ratio, by half a percentage point. The increase in repo rates results in cost of money going up. The CRR hike results in suction of money from the economy. A day later, the Fed increased its lending rates by half a percentage points and made known its intention what it is going to do in months ahead. It said it will go through the interest rates hike. There could be many interest rates hike which is going to happen during the year 2022. It also made known its intention to bring down the size of the balance sheet, which actually means that they were going to suck out liquidity from the system and constrict money flow into the economy. Why did the central bankers do this? What's the intention behind this? What exactly the central bank is trying to achieve by doing these activity in the marketplace? To know the answers, we have to again go back 2 years prior. 2 years prior, when the lockdowns happened as a reaction to the pandemic, the private sector was on the verge of collapse. There was no activity which was happening in the private space. The economy was on the brink of collapse without any activity. Somebody has to do something to keep the economy afloat. The governments in the respective countries and the central banks took this responsibility to keep the economy floating. What did they do? They flushed the market with liquidity, and they infused huge amounts of cash into the economy just to keep the economy afloat. How much cash did they spend? Humongous amount of money. Just the G7 countries alone pumped in more than $9 trillion worth of cash into the economy. India also was not left behind. India too pumped in $300 billion. 300 billion appears to be a small number for Indians. But let's look at how big is 300 billion. A $1 billion is 7,500 crores. $100 billion is 7,50,000 crores. A $300 billion is over 20 lakh crores of rupees has been spent by Indian government just to keep the economy running. It worked like an anesthetic. It worked like a soothing balm. It worked like an hallucination for the participants of the stock market, and the stock markets danced to the top. But every action has a reaction. When you try to do something which is not supposed to be done, it will leave behind the side effects. The effects of pandemic are waning. There was no side effects for the vaccine, but for the economy, this massive spending which was done by the government is resulting in an inflationary environment. This kind of an inflation was not seen for several decades. In fact, most of your viewers have never seen this kind of an inflation during your lifetime. People of my age, people who are above 55 years of age, have got the memories of what can inflation do and how it can have a knockdown effect on the economy. Such kind of an inflation was in the 70s, it was there in the 80s. In India, between 1985 to 1995, the bank FD rates were 14%. Why it was 14%? Simple. It was a reaction to control the inflation which was there on the ground. For most of your viewers, you have not seen this. In US, you have not seen this kind of an inflation for a long period of time. Current rate of inflation on ground in US is in excess of 7%. Recently, we got a news from UK, the inflation on ground is more than 10%. Inflation in most of the Eurozone is over 5%. Inflation in Africa and South American countries have no meters to measure. That's the kind of inflation. We have seen the news coming from Sri Lanka because of inflation, what kind of a problems that country is going through. Now the problem of inflation is not restricted to India or US or one single zone. The whole world is going through this particular problem. Is this inflation is because of a Ukraine war? Is this inflation is because of lockdowns in China? The answer is yes and no both. Ukraine war disrupted the oil supplies or disrupted the oil supplies. The supply chains got disrupted because of the latest lockdown which is happening in China. But this has nothing to do with the present inflation what you are seeing. The problems in Ukraine, problems in China are aggravating the problem of inflation. But these are not the root cause of the current inflation. The root cause of the current inflation is excessive spending by the different governments across globe. Now the side effects of this spending are visible. It's not a small problem. It is not a problem which can go away. This is a problem which requires a massive action. This problem cannot go in 1 month, 2 months, 1 quarter, or maybe a few years. A big action could be required from central banks and the government. The road ahead is not an easy one. That's exactly the thing the stock markets are seeing, and they are correcting as a response to this inflation, as a response to the government's action of increasing the interest rate and sucking out this liquidity. Now let us look at how can an inflation affect the stock market. Inflation has problems at 2 levels. One at governmental level, the second at the corporate level. What's the problem that will happen at the governmental level? When inflation rises, it is the poor, the marginalized persons who will get affected. Their incomes will not rise in tandem with the rising inflation, because of which it can result in unrest in the society. The governments may not remain in power if inflation gets out of control. What are we seeing right now in Sri Lanka? This is a response to inflation. This is a response to what's happening on the ground. So any government which is in power will try to do everything possible to contain the inflation and contain the political costs that come with the inflation. What's the problem that happens at the corporate level? Now when inflation rises in a society, the purchase power of the common man comes down. The cost of goods and services rise. Their incomes do not rise proportionately or at least immediately. As a consequence, the spending comes down, which means to say the corporate revenue growth gets affected. When the corporate revenue growth gets affected, their profitability gets affected. Likewise, the inflation also hits the corporate world by increase in the raw material prices or increase in wages. So on one side, there is a reduction in demand, on the other side there is an increase in cost. The net result is the corporate profitability will come down, which means the earning per share will come down, which means the nifty the earnings will come down, and the stock markets have to react. Stock markets will not react when they see the news. The stock markets will take cues from the news which are coming ahead, and stock market reacts to this well in advance. That's precisely the reason why the stock markets are coming down in India and in the rest of the world. What does the central banks do to control the inflation? Central banks have a mandate to control the inflation. RBI says its comfort zone is at when the inflation is at 4% level. It should not cross 6%, which is sacrosanct, and it's a red flag. Where is the inflation in India currently? It is in excess of 6% at the consumer price index level. So that means red flags are flashing all over. That's the precise reason why the Reserve Bank governor increased the repo rate, why the Reserve Bank governor increased the CRR hike. He intends to curtail the supply of money into the system. He intends to make the cost of the money or cost of borrowing higher. When RBI or any central bank increases the lending rate, cost of money increases. People will hesitate to borrow, or the affordability of people comes down. The EMIs will increase, and overall the demand is controlled. When the CRR hikes increase or the liquidity is sucked back, the Reserve Bank says to the bank, look, please do not lend so much to the market. You have to keep so much extra as a reserve. That means it flushes, it sucks out the liquidity from the marketplace. So both these actions will bring down the inflation to a cooler level. At a corporate level, because the cost of money increases, the companies which have borrowed, companies which have got the leverage balance sheet will get badly affected because of rise in interest cost, and their profitability comes down. That's another reason why the stock markets are coming down. Now this rise in interest rates is not restricted to India. This is happening all over the world. The one bank which is of interest, or one country where we are more interested, is what's happening to the interest rates in the United States. US dollar is the world's reserve currency. If anything happens in US, it will have a ripple effect in all other parts of the world. When US increases its interest rate, which it has already started and said that several rounds of increase in interest rates will follow through the year and in next year, what happens? The dollars which are moving around in the world, invested elsewhere in the world, particularly in the emerging countries, will come back to US because they have a better opportunity in US than in the emerging market. Now you have seen the FIIs selling relentlessly for last few months from the emerging market, and even in India this has happened. So when they sell, two sets of problem can come. One, the dollar rupee equation may get affected, as well as because of the relentless selling, the stock market will also come down. If there is enough forex, we can still absorb the FI selling and moving out of the country. It can still be managed, and luckily enough we have enough of forex reserves in India, and we may not see a rupee falling drastically the way it used to fall in the yesteryears. Likewise, the selling FIIs is well absorbed by the domestic investors right now. There was a time when FIIs used to sell, the Indian stock market used to fall like 9 pins. But that's not happening. Yes, the markets are coming down, but it's not that there are no buyers in the market. The institutions, the insurance companies, the mutual fund companies are buying in the market. The SIP book in India today stands at about 12,000 crores. That's a huge number. So the SIP book, which is maintained by the mutual fund, the retail investors who are putting money through the SIPs are absorbing the selling which is happening because of FIIs selling. So India is in a far better shape. Markets will come down, but it also has an absorption capacity because of a good forex reserves. It's also because of the good SIP books which are there with the mutual fund houses as of now. There's a good amount of business which is happening at the insurance companies. Insurance companies are also buying into the market. So it's not something that it's a pathetic situation here. But if this situation continues going forward, and if a capitulation phase comes in the market where people will become very concerned, they are not experienced, this could be the do-it-yourself investors, this could be the investors who don't have a risk profile to stay invested in the market, or if they are leveraged and they have to sell it off, then we can't say. If people close their SIPs, then Indian markets can also get affected. So this kind of a problem which is happening is a tectonic shift which is happening in the stock market. Stock markets have not seen this kind of a problem for many decades. As I said, this kind of a problem existed in the 70s and the 80s, and from 90s onwards the inflation has cooled down, and for last 3 decades the world has not seen this kind of an inflation. So this problem is here to stay. It will take time for the central bankers and the governments to contain this inflation. It will not go in one day, 1 month or a couple of quarters. It could take couple of years before this monster of inflation is tamed and the business is as usual normal like what it used to be earlier. So please keep at the back of your mind, this problem is here to stay, and it takes a long period of time for things to get normalized. Till such time, it's fair to expect the stock market languishing here. Maybe it will stabilize here, maybe it will drift down here, maybe it will have a sharp sell-off at some point of time in future. All 3 possibilities exist. Dear viewers, I'm a financial planner. My job is to keep your portfolios intact. My job is to design things for you in such a way that you get benefited from the evolving situation of the day. If you think inflation is unfolding and if this is an opportunity, we know how to design your portfolios. If you're a person who is looking out for professional help to help you in your investing journey, you can make best use of our services. You can contact us through a WhatsApp message on the numbers that is shown here on the screen, or just enter the form which is given here below, and one of the financial planners who is working with us will help you to design a robust portfolio for you to manage the current environment, also to get benefited from the evolving situation. So why delay? Send that message now. Dear viewers, hope the video that I have done today helped you to understand what's happening in the stock market and what's making it behave like this. It should have helped you also to what to expect going forward. If it did, please like this video. If you are a person who is watching this episode for the first time, or if you are yet to subscribe for this channel, please hit the subscribe button and press the bell icon. Don't forget to share this video with your near and dear ones. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another useful topic in yet another video very soon.
Press the bell icon for more details and subscribe our channel.